Hello subscribers! I know most of you expect some bombastic intro to these videos, but today we're gonna cut right to the chase. We have two huge days to end the week with earnings and inflation data coming into focus, and we need to talk about it. So make sure your phone's on silent and keep all hands and feet inside the vehicle at all times, and let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very green day. Last time I saw this much green, I was hiking through the Amazon. True story. Guys, there was no real leader here today. It was just a whole bunch of sectors, a bunch of stocks just rallying, a ton of green. But let's talk about the red. Nvidia pretty much flat on the day, down 0.2%. That's because the broader semiconductor trade actually did rally, as well as the broader technology space. Microsoft infrastructure, which has been on a tear the last couple of days. This has been the outperforming subsector in the tech space in the last week or so. Apple up 1.59%, but we did see some concerning stuff. Google and Meta were both down 1.87%. Google on the back of some news from the DOJ weighing up the risks of a breakup, asking Google to sell some of its businesses as to not have such a huge monopoly. That weighed on Meta, but not the entire sector as a whole. We actually saw the comm services sector very green, entertainment and telecom very green across the board. Tesla was down leading up into its 10/10 event. That's going to happen sometime tomorrow. Amazon, as well as consumer cyclicals, was very green as well. And all of this rally just stemmed off the Fed's minutes. Now we saw broad-based gains across the board except utilities. They were the only red sector here today, down 0.8%, but they're the best performing sector year to date. Kind of crazy when you think about that. And look at comm services, up 0.1% when Google and Meta were both down heavily. That just goes to show the strength in the broad index to actually see that flat and not significantly down. Now the Fed's minutes really did power today's gains, and the September minutes show that a substantial majority of officials supported a 0.5 percentage point interest rate cut in the last Fed meeting, and only some participants supported a 25 basis point interest rate cut. And pretty much these minutes confirmed what we all thought all along, and this sort of relieved investors. There was a debate about the 50 basis point cut and 25 basis point cut, meaning that it wasn't a sweeping consensus that we needed to do a drastic 50 basis point cut, and that's why the markets really did rally today. And pretty much what these Fed minutes told us was that the Fed cut 50 basis points, not to get ahead of any economic weakness, but just to get ahead of the curve because real rates were a little bit too tight. Their cutting wasn't on the back of any economic weakness they were seeing necessarily. Following these minutes, the markets are now pricing in a 24% chance the Fed doesn't cut rates in its November meeting. This is up significantly from a day ago and up from a 0% chance a week ago. So there is market pricing that we actually don't get a rate cut in November, but it's very likely we still are going to get 25 in November. And I think maybe if the Fed aren't going to do any cuts, it's maybe going to come in December and January as well. Either way, the market rallied. The market liked what they saw in the minutes, and it was broad-based gains in large caps, in small caps, but very focused in the large caps and growth segment of the market. Large caps outperformed, mid cap growth, small cap growth outperformed as well. But that's not to say that value and core didn't participate. They actually did, just not as much as large size as well as the growth factor. We also saw gains in the global market, all except China and Asia for the most part. The flows in China brought most of Asia down except for India. The Australasian market was fairly robust today. Same too with Europe, bucking the trend of a red China, red Europe, and then North America green, South America red, mostly on the back of Brazil, but a very bullish day globally, especially when you consider that Europe and the US make a majority of the global stock market. And diving into the charts, stocks were very resilient in light of all of the moving parts we saw today. The 2-year, 10-year and 30-year yield were all up 1.62, 1.42, 1.12% respectively, and the dollar gained. That's a double whammy. Stocks do better under a weaker dollar, but that's just the price action we're seeing. When yields are more attractive, people are going to go to cash because they collect interest on that cash, and that's why we saw yields rise and the dollar rise. So now stocks broadly did gain, don't get me wrong, but we did see outperformance in large caps, higher quality names which are more resilient to rates and a stronger dollar. Stuff like the S&P 500 and the Nasdaq 100 up 0.7, 0.8%. And to be honest, the price action here in yields and the dollar probably did put a cap on activity. If we saw like a flat dollar, flat yields, we probably would have seen gains upward of 1%. And then we saw high volatility, high beta, lower quality assets, stuff like the IWM underperform. The RSP actually performed in line with the S&P 500. And so really what we saw was just a movement into sort of the large cap, mid cap space. But we did see broad participation here in the IWM. However, look at the after hours, down 0.22%, so virtually flat on the day. And we are seeing a little bit of downward momentum here in the after hours today. But inconsequential, you really want to look at the after hours when the Asia session opens, because then you do see a little bit more volume in the after hours trade. All in all though, a very solid day for those that were in stocks, but not really anywhere else. If you were in bonds, bonds fell, commodities fell as well. That happens when the dollar's stronger and yields are stronger, because commodities don't produce a yield, whereas cash does. And that's why we saw the market price action we did today. But all of the dynamics saw equities rise. The S&P 500 rose. This is the year-to-date chart. Look at this chart. Very, very strong. Another new all-time closing high. And it sort of looks like a breakout. Just yesterday we were saying maybe we just range in this area and then we get a breakout to the upside. Well, it looks like the breakout's starting today. A new all-time high breakout. Guys, our target is the 5850 call resistance. The 5700 is still the gamma flip and the 5650 is still the put support. And that means we buy dips, sell rips. I would love to see the gamma flip move up. Still hasn't, but we're buying dips, selling rips all the way to the 5850 area call resistance. Very, very resilient. The S&P 500 went from looking very, very mediocre just yesterday, even though at new all-time highs, to looking very, very strong. Amazing what one day of trade can do. Looking at the Nasdaq 100, we're at these equal highs, virtually at the core resistance. A couple more points and we're going to get there. We go ahead, break these highs. Is that actually a closing high on a technicality? So let's actually have a look. So the high is 20,284. The high on that chart is 20,273. So yes, this actually is a new closing high against that high right there, ever so slightly. We actually did put in a higher high on a technicality. That opens up this highs and confirms this as a higher low relative to this and this. Very strong price action, momentum in the large caps, despite what we're seeing with Google, Meta, and Nvidia today, which were all three of those names were down to flat. To see the movement we did in the Nasdaq 100 goes to show the broadening in this index and just the relative strength of all the other tech names like Microsoft, Apple, etc. Looking at the RTY, even though it underperformed the market today, still a gain. You still take those gains when they come, and still looking like this is a higher low, but I do want to see a push up at a moment's notice if this breaks the gamma flip zone or a negative gamma and things start to look ugly for the RTY, and the gamma and the zones have not changed as well. But equity is looking very, very constructive across the board. The RTY, the RSP as well, that looks very, very strong. Not quite as strong as the S&P 500, which made a new all-time high. Almost looks like a breakout if you ask me, but equity is looking very, very strong. Valuations are rich, but at this point, guys, you should really already be positioned in equities at these lows. We've been talking about it all year. We've been long all year. We've been bullish all year. And really what you want to do now is just to hold equities. And that's why I've been buying stuff like gold, sort of diversifying away and looking at individual names, stuff like PayPal, looking for value, right? PayPal today moved in line with the market, but up significantly. My entire PayPal position at the moment is up 38%. I initiated this position late February, early March, sort of around this period right here. And I held through the ringer for like 6 months, and now I'm reaping the rewards. Another great play that I like if you're looking for value in this market is Paycom. I said to buy right here. My average position size is at 142. I'm up about 18% on this position right now, and I do think it's very, very undervalued. Now, if we actually just drop away from the charts and just look at some like forward-looking metrics using free cash flow for Paycom as well as PayPal, we see these stocks are very, very undervalued. Looking at Paycom, we pop in the trailing 12-month revenue, a revenue growth of 10%. By the way, these are conservative figures. Actual revenue growth is closer to 12%, and the actual free cash flow margin is closer to 33%. But if we model up to 2029, $2.8 billion in revenue, $880 million in free cash flow, which they're expected to do $1.2 billion in 2029 analyst estimates, and then we use a free cash flow multiple of 18. The industry average for HCM providers right now is 22. It's currently at 28, so we're actually forecasting multiple contraction, right? So an 18 multiple, which is conservative, that's below the market average at the moment. You get the enterprise value, remove the net debt, that's the equity value. Then we model a 1% decrease in shares outstanding to get 55 million shares at the end of 2029 from 57 million. That means the stock price will be $317 if we divide the equity value by the shares outstanding. The current stock price is 163, and then you add a 1% dividend yield. That means you're looking at 5-year projected returns in Paycom at 15.16%. And if we use my target that I bought out of 142, I'm looking at 18% compounded annual growth in this name. It's why I like Paycom, undervalued and very similar to PayPal. If we do the exact same, put in the trailing 12-month revenues, forecast 9% revenue growth, 21% free cash flow margin, we get $9.7 billion in free cash flow by 2029. Then we have a multiple of 12. The current free cash flow multiple is 12, so we're seeing no multiple expansion or contraction. By the way, I think we're going to see multiple expansion in PayPal. I think this stock can trade at like 14 or 15 free cash flow multiple very, very easily. Then we get the enterprise value, $117 billion, minus the net debt. Then we get the equity value divided by shares outstanding, and we're currently looking at 3% share growth over the next 3 years. That brings us to a stock price of 136 in 2029. The current stock price is $81. They don't pay a dividend. That means from the current price of $81, you're looking at 10% compounded average returns for the next 5 years. And if we look at my average buy price of 55, at the time when I bought, it was 19%. And that's why I bought PayPal. And so I think if you do look at names like these, you're going to find value outside of markets which are richly valued. And that's why I'm saying, guys, look for undervalued plays in the market. Look in the mid cap, small cap, value and core segment. Even though PayPal is a large cap name, Paycom is a mid cap name as well. So you can find value in the market despite valuations being as rich as they are. And that's why I like Paycom. That's why I like PayPal. But if you do have stuff like the S&P 500 and NASDAQ 100 in your portfolio, don't sell. We are going higher. We're going to hit the 6,000 level before the end of the year, if not early 2025. There's still plenty of upside. We're in the second year of what's probably going to be a 5-year bull market. So hold equities. And if we do get dips like we did right here, and right here, load the boat, because we are in a Goldilocks environment at the moment. Looking at seasonality, sometimes when we get a whole lot of volatility in the market, it's sometimes good just to take a step back and look at the bigger picture. And this is essentially bull markets the S&P 500 has been in and has gone through, the average change from peak to trough, and how long each of these bull markets has lasted. Now you can see here in 2024, the current bull market from the 2022 lows to where we are right now is up about 61%. It's been a very, very prosperous bull market. The bull market is 2 as of this Thursday. The average bull market lasts about 5.5 years, the median about 5 years, so we're not even halfway, guys. And the average gain in that time is 180%, median 107%. So whichever way you cut the cookie, there is still plenty of gains to be had when the fundamental picture is looking rather constructive. Right now, Q3 blended earnings growth coming in better than expected. Estimates at the start of this earnings season was 4.7%. Right now, we're reporting 5% earnings growth. Now, do take into consideration only 21 companies have reported earnings, and the only big company that's reported so far has been Pepsi. Revenue is right on target at 4%, and if you remove the energy sector, things looking a lot better. 4.8% revenue growth, 7.1% earnings growth, and margins unchanged from analyst estimates at 12.1%. Looking at the bigger picture of earnings, we're seeing 2024 revisions tracking above the historical average, yes, but we have started to see downward revisions in 2024 earnings. This obviously means Q3 and Q4 revisions are coming down from their highs, and we were expecting at the start of the year about 6 to 7% in earnings growth in Q3. We now see that at the start of earnings season, we were expecting 4.7%. So we clearly have seen downward revisions in third quarter estimates, but I do think that the majority of these revisions for 2024 probably come from the fourth quarter. We're also seeing 2025 revisions. While we are seeing general up revisions for the most part, in recent months we have seen down revisions. This is actually something I've said for a while now. I thought and still do think the 2025 estimates are still too high, and I do expect this number to probably come in line with this average right here, the ex-COVID GFC and Y2K average. This is what BofA expects. Now, I have no research behind my backing other than just the stuff I'm seeing on a day-to-day basis. That being said, do expect more of the same in down revisions for 2025, but I think from here we should trade largely flat in Q3 and Q4 earnings. Why? Because Q3 earnings are coming in better than expected, as I've just showed you, and I think for the most part, most of the revisions downward have already materialized in Q4. However, guys, we are still reporting year-over-year earnings growth, and the bull market we're in right now is actually an earnings-driven market. Earnings have driven about half of the S&P 500's return over the last year, and we normally go through these cycles where a large part of the gains is driven by multiples and a large part is driven by earnings. And in the last, I would say 4 to 5 years, the majority of it has been in earnings growth. Very, very constructive in this bull market. Now, what are some great ways to play earnings season in the next couple of weeks, especially as earnings ramp up? This is from LSEG. They just got some data here, and these are companies that they expect to have positive earnings surprises. These are companies they expect to have negative earnings surprises relative to analysts' expectations. If you are looking to play earnings to the upside, you can look at stuff like Alaska Air, Newmont Corporation, CH Robinson Worldwide, Maple Bear, which I believe is Instacart, and Snowflake. And if you're looking to play earnings to the downside, maybe looking for a short into earnings on a negative surprise, you can look at JB Hunt Transport Services, General Dynamics Corp, Centene Group, Mosaic Company, and Marathon Petroleum. Those are ways where LSEG believe they're actually going to see negative surprises for these company names. Very, very interesting. So as we go into earnings season, we're going to talk more about earnings and where we stand in the S&P 500, guys. So expect more of the same and follow me so you get the most up-to-date earnings figures. In the thick of earnings season, I provide the most up-to-date earnings figures every single day right here on YouTube and Twitter, or X, whatever they're calling it these days. And diving into the macro, very, very interesting, guys. This is BofA's GDP forecast, and they forecast real GDP growth for 2025-26 to be not that stellar, despite the economy and the data being very, very Goldilocks. Now, they expect a fourth quarter GDP print of 2%, as you can see right here. Then the first 3 quarters of 1.5% for 2024, 2% in the fourth quarter, and then in 2026, they expect 2% growth for quarters 1 and 2, and then 2.5% growth for quarters 3 and 4. So they do see lackluster growth into 2025 and then moderate growth thereafter. And on the back of this, economic data is looking largely robust. The US is now actually delivering positive economic surprises versus the rest of the world. You can see this green line is above the 0 line. This means that economic data is coming in significantly better, and it's actually outpacing the UK, Japan, emerging markets, as well as China and the Euro area. So the place to be from an economic standpoint is definitely the US market, and a strong economy means strong earnings, and when earnings are strong going into rate cuts, stocks do very, very well. And on the back of this positive data, we've actually seen Goldman Sachs cut their recession probabilities from 20% where they were to 15%. Very interesting that they actually track a recession probability indicator. The current Bloomberg consensus is at 30%, and just for the record, guys, that the long run average recession probability is actually about 15%. So where we are right now, or at least Goldman Sachs estimate, is actually at the long-term, long-run average. So based on this, there's still a bit of fear in the market, at least when compared to consensus estimates, especially with the current estimate at 30%. Take that as you will. I personally don't think we're going to see a recession. I think the economic data is proving we're not going to see a recession. And look at these GDP figures. No recession in sight. If you ask me, none of this data is recessionary. Now, diving into earnings for the rest of the week, it really does kick off tomorrow. We have Delta and Domino's. They get things moving. And then on Friday, JP Morgan, Wells Fargo, BlackRock, and a couple of other companies. Looking at data though, guys, tomorrow, initial jobless claims. The forecast figure we're looking for is 230,000. And then we also have CPI headline and core figures. Now, the year-over-year headline figure we're looking for is 2.3%. That's the median forecast. And then the core version, 3.2%. Month-over-month, analysts forecast CPI to come in at 0.1% and 0.2% respectively. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.